The Federal Open Market Committee decided to raise the target range for the federal funds rate by 1/4 percentage point, bringing it to 3/4 to 1%.
Years ago, last month, home prices nationally hit their peak of the housing boom, and we all know what happened after that. Values dropped for 6 years by the most in history, but somehow we are almost back to where we were. Take a look. June marks 50 consecutive months of annual national home price appreciation, with prices up 33% from that bottom in 2012. A new report from Black Knight Financial Services put the home prices in June at $265,000, and that is within just 1.1% of a new record high. Now, going locally, of the nation's 40 largest cities, 14 have already seen home prices cross to new highs. Those include Austin, Boston, Charlotte, Dallas, Denver, Pittsburgh, Portland, Oregon, San Francisco, and Seattle. Only St. Louis saw home prices drop annually.
Roughly 180,000 single-family homes and condos were flipped in 2015, according to the report. Home flips accounted for 5.5% of all U.S. sales in 2015, the first annual increase after 4 consecutive years of decreases and the highest number of flips since 2007. The states that accounted for the highest share of flips in 2015: Nevada, Florida, Alabama, Arizona, and Tennessee.
In the global financial crisis era, a change in policy without this hand-holding would probably get people to feel that there was a bit of, say, financial stability risk at play, which is why the central banks would be moving. And that could do some damage to equity markets, which, as we know, is the unofficial, third mandate from many of these central banks. Do not disturb equity investors.
Now, US stocks finished lower Tuesday on a continued drop in oil prices, and as the Federal Reserve kicked off its 2-day rate-setting meeting, the Dow Jones Industrial Average finished 0.2% lower at 20,837. The S&P 500 dropped 0.33% to 2,365. A 1% fall in the energy sector led the declines, taking a hit from yet another drop in oil prices. Wall Street was also pulled back as investors prepare for another almost certain rate hike.
B of A recommending that investors buy S&P 500 puts for the second half of 2017. Research.com published an article today by Tyler Durden. The Bank of America sets a date for the market's great fall sometime during the second quarter of 2017. The points made in the article are very interesting. With the U.S. stock market likely to continue its levitation today, it means that by close of trading, the S&P 500 will be above 2,400, the same as Goldman's year and price target, and 100 points away from Bank of America's euphoric blow-off top destination, which is also known as Michael Hartnett's Icarus trade. In a note released overnight, Hartnett confirms that he is sticking with our Icarus trade target, even as he admits that the euphoria level in stocks is unprecedented. The article goes on to contend that historically, once the Fed start tightening, it keeps tightening until there is a financial event. See chart 4. This is likely to occur at a much lower rate of interest than in the past, given the economy and market's reliance on QE in recent years. And there's a chart here also that shows the tightening once the Fed started. In 1929, the Wall Street crash. In 1937, the Fed's policy mistake created worsening financial conditions. In 1970, there was a Penn Central Bank incident. Then the Franklin National Bank in 1974. In 1982, the Latin American debt. 1987, a stock market crash. 1990, the SNL crisis. 1994, the tequila crisis. Wow. 1997, the Asia-Russia LTC. In 2000, there was a tech bubble. 2007, the subprime crisis, the B of A AML targets for 2017. So another warning from the increasingly concerned Hartnett. Extreme U.S. rate differentials can cause financial instability. U.S.-German 2-year rate differentials are currently at a 28-year high. Rate differentials this wide have in the past either required policy intervention or have coincided with bad events, such as the 1987 crash, the 1997 Asian crisis. So we have a timetable here, according to B of A, those at B of A, that they recommend, down at the bottom here, they state that B of A, we recommend buying S&P 500 puts for the second half of 2017. So just to let you guys know that there will be some event that investors, banking institutions are expecting it. They're expecting it to come on the heels of the Federal Reserve not knowing when to stop tightening or raising interest rates, changing policy. So just to let you know that what we predict, what we see happening is not as far-fetched as the mainstream media would like us to believe, because now, today, March 15, 2017, banking institutions are starting to speak out that they also see an issue. Okay, guys, have a good day.